Before we start, Andy, I'd just like to say a quick thank you to our podcast sponsor, Fidelity International. Now, Fidelity is one of the best known investment platforms and global fund managers out there and is responsible for around £320 billion from over 2 million clients globally. Now, I currently use Fidelity's investment platform to run my own 80/20 investor portfolio, and they give access to ETFs, investment trusts, shares, and even unit trusts. For investors looking for ideas where to invest, then Fidelity also offer guidance, fund shortlists, alongside fund suggestions from their investment director, Tom Stevenson, who also happens to be a columnist for The Telegraph. Now, don't forget that you also have the option of putting your money in cash now, so you can secure your ISA allowance and make your investments later once you've made up your mind. Also, if you invest a lump sum in an ISA online by the 31st of March 2019, Fidelity will also give you the chance to win back your initial investment up to a total of £20,000. Now, if you want to find out more information, you can do so at fidelity.co.uk. Now on with the show.
Hello and welcome to episode 215 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leeks. Damien, welcome back. How are you doing?
Good. I actually feel like I don't have a cold, unlike every other episode I've done since the start of the year. So I'm in a positive mood.
Good. Well, that's just as well actually, because we've had a busy old week, haven't we? What have we been up to this week?
Well, this week we've done a hell of a lot of new content, and one of the pieces is actually going to be something that Andy did and wrote about. It's going to be one of the pieces later in the podcast, but we've launched a new show, and it's an exciting show which I'll come on to in a minute, but we've been arranging all sorts of things and with third parties as well. So one of the things I want to talk about quickly before you get into the show is on the 3rd of April, so it's just over a week's time, I am doing a panel discussion at the General Assembly, which is in Whitechapel. It's a free event that's being hosted by Habito. Nested are on there. They're the site that help you buy a house. There is Moneybox. So they have an app whereby you can save your pennies and invest. And of course, there is me on the panel. We're talking about the future of buying a house, talking about investing, savings, the whole shebang. So if you're in any way interested in any of that, but more importantly, if you're interested and keen to meet us, so I really want you all to come. I'd love it if the place was flooded with Money to the Masses listeners and readers. So please, please, please come, because we're going to go to the pub afterwards, and that would be brilliant. Some of the team are going to be there. Andy's likely to be there. Lauren is likely to be there. Justin is likely to be there. So we want to make it an event where it's kind of a meet-up. So put it in your diary. It's the 3rd of April, Wednesday evening. It starts at 6:30. It goes on for about an hour and a half, and you get plenty of chances to ask questions and chat and mingle afterwards. So, like I say, all details are on our social media channels. So we posted it on Facebook, we pinned it, Twitter. So if you want to find out more, go and look at our social media channels where you can find out more. We'll be talking about it in the sort of coming days and week.
Excellent stuff. I'm looking forward to it. So what have we got on this week's pod?
Right. Tax year checklist. It's that time of year where the tax year is coming to an end, the 5th of April, so only 2 days after that event I just talked about. So we've got a tax year checklist, all the things that you should be doing beforehand to make sure you don't lose those allowances and reliefs that you're all entitled to, and make sure you use them. We've also got an insurance piece, which Andy's going to be doing, and given the time of year, we're going to spring clean your finances. So it's quite timely given that it is the March the 21st, which I think is marking about the beginning of the spring as well. But before we jump onto those pieces, I want to talk about the Millennial Money Show. Now, that is the name of the new show that we're doing. It's going to be on YouTube, you'll see it on Instagram, and it's driven by Lauren. Now, Lauren, as many of you will know, joined us at the beginning of the year, and she's a millennial, and I hate that term of pigeonholing people, but it is a term that's widely used, and what we wanted to do was give stuff that was relevant to people at a different life stage. So a lot of the stuff we might do on this podcast, maybe for people who are already in certain life stages might have money, but we want to do something for younger people, and there's a gap in the market because no one's really doing it, and they're not doing it very well. So we've got a TV show, a video show that we're filming and putting out each week where Lauren and I sit there and discuss particular topics around money. It's going to be deliberately quick. It's going to be deliberately light-hearted, visually more interesting, but it's something I'm really excited about, and we're allowing Lauren to drive that. So if you've got millennial children or you're a millennial, then make sure you have a look at it, because we want that to be something that they can sort of be theirs and follow and influence, because there were people at our last meetups who had children. We're trying to get them to listen to our podcast and things like that, because they thought we could help them and help their sort of the younger people. But we're now actually making something very specific, and I'm really buzzing about it.
I'll tell you what we'll do then, Damien. Why don't we play a little clip from this week's show into this podcast? We'll see the listeners on the other side. It'll only be a couple of minutes. What do you think?
Good idea.
So to kick off the first episode of our little Millennial Money series, I thought it'd be really good if we could speak to Damien and ask him what 3 things he wished he knew when he was in his mid-20s that would try and help us out. So Damien, what 3 things do you wish that you knew?
There's a lot of things I wish I'd known when I was in my mid-20s, and what I was going to do is just give you 3 things that I think would have made me better with money, but nobody ever taught me. So we'll start with number 1, and I wish I'd known the value of money. Now, by that I mean, yes, how much you can buy in the shops, that we kind of all know, but the thing I didn't appreciate is the real value that it meant to me. So if you have a job, and I was frivolous with money, I used to spend it like it was going out of fashion. I used to buy what I wanted, go down the pub all the time, like everybody does who's in their mid-20s. The problem was I didn't really know the value of it. So if I had a job, what was my hourly rate? Or even if I wasn't paid by the hour, what would my hourly rate equate to? If I knew that, then I would have known how much or how many hours I would have had to work to be able to buy the frivolous thing that I bought, or that night out down the pub, or all those things. And that would have probably helped me not get into as much debt as I did. Because I'll be honest with you, although I do the money stuff now and then expert and all those things, I made all the mistakes that everybody else made and learnt from them. So it would have stopped me getting into so much debt as I did in my early 20s.
If you're out there thinking of buying that nice Louis Vuitton handbag, think how many hours it might take you to buy it. And I'm not saying for 1 second to not buy it, because
Because you probably bought a lot of Louis Vuitton handbags.
I've got about 6. Not Louis Vuitton, no, Michael Kors.
See, I don't even know. Louis Vuitton is like fashionable, isn't it, Lauren? So this is the point that Lauren's making me relevant, because
I have a very good motto: is do I need it or do I want it? And if I need it, I buy it, and if I want it, I also buy it.
Yeah. So what I'm trying to say is, I worked out rather later than probably Lauren has about the idea of what the value was. So once I did that, then I realised I was having to work about a day or two to be able to afford the thing that I won't get into the worst thing I ever bought. I will do one day in this series, the things that I bought, the frivolous things that would, trust me, if you're watching this video, I probably have bought something that's far more frivolous than you did when I was in my early 20s. So that's number 1.
So there it was, the clip of the very first episode of Millennial Money, an uninspiring title, but I tell you what, it's going to be an inspirational piece going forward. And so if you want to see the whole video and you want to see the rest of the series, you just need to get yourself over to YouTube, search for Money to the Masses, and you will find it. Click the subscribe button, click the little bell that tells you, and it will give you a notification to tell you when there's new videos up. And every week we'll be dropping those through. And what we'd really love is we'd love you to interact with those, feedback to us, and share them amongst your friends, your family, and anyone who you think they might be relevant. And actually that can help shape what we do going forward. Lauren herself's got loads of ideas, being the millennial that she is, but she could really help with you guys telling her what you want to hear as well.
Yeah, and we need to have more females in finance. And it's great to talk about that we need them, as Money to the Masses want to encourage that. And so having a young female talking about money as well is, I think, particularly powerful. So we want to be able to tap into that audience out there that isn't actually being serviced in any way at the moment. So let's get on with the rest of the show and start with the longer piece, which is about the end of tax year checklist. Now, it's that time of year, so all those things you should be thinking about doing, just making sure you've done them. we'll start with pensions. Now, the tax year ends on the 5th of April, as it does every year, but there are lots of allowances and reliefs that we're all entitled to that reset every year. Some you can carry over, some you can't. Now, if we look at pensions, when it comes to a pension, we all have an annual allowance, how much we can pay into a pension each year. If you're wealthy enough and fortunate enough to be able to have the money, you can pay up to £40,000 a year, but it's 100% of your earnings, up to £40,000 a year. And if you don't even earn any money, you can still pay into a pension. It actually works out to be £3,600 a year gross. So if you want to work out the net amount of that, you just take off 20%. So that means that your spouse, if your spouse doesn't work, you can, in theory, pay into a pension for them and start building up a pot, and they can get tax relief on that, even though they're not actually paying any tax. So with your pension allowance, you want to try and use as much as you can if you want to build your pension pot. So you need to put that money in before the 5th of April. And those limits I talked about earlier are relating to the amounts you can get tax relief on. So don't forget that when you pay into a pension, you get a nice Brucey bonus from the government on top, which is tax relief. And of course, if you imagine auto-enrolment, so if you're employed and your employer will have to pay into a pension as well as you, then the government also pays in. I mean, that is pretty impressive that you get to the point, I don't think people realise that with auto-enrolment and company pensions, you get to the point you pay in, but there are two other people who are paying in as well. It's like free money. If I came up to you and said, look, if you put in a certain amount of money, these two other people are going to put in money for free in this box, and they'll do it forever as long as you're doing it, you'd think that was an amazing idea, and you would keep putting as much money as you could into that box. The fact it's a pension is slightly sort of unsexy, unattractive, that people sort of glaze over. But if it was just a box in the street, we'd all be doing it. So max out your pension contributions if you can. Now, there is another rule which you can do. You can carry forward pension contributions. So although the allowance for a pension contribution works on each tax year, if you miss a year or you have any unused allowance from a previous year, you can actually carry that forward and use it this year, and you can do that for up to 3 previous years. So if you think about it, that means that if you had 3 previous years, you can go back and get 40,000 from last year if you wanted to, or the year before that, if you've not used it. And the reason people do that is because they may have slightly lumpy earnings, where they may have not earned so much in previous years, sort of taxable earnings, but they suddenly do this year. So you've got to have paid the tax to be able to claim the tax relief in this year. So you can carry forward pension contributions, and of course there's a time limit, because like I said, you can only do it for 3 years. So after this year, that means another year drops off the list at which you could claim the unused allowance. Now, as I said, you can pay into your spouse's pension as another one. But on state pensions, you can actually boost your state pension. And you can do that by topping up any shortfall in your national insurance contributions. Now, they're voluntary contributions you can pay. So if you want to top up your state pension, because it's based upon your national insurance contribution history, and you may have bits that are missing. If you want to top it up, then you can do so up to 6 years prior. So there is a window that goes back 6 years. You have to pay the additional contributions within 6 years of the point that you're trying to basically boost. And of course, with each tax year that closes, that means that you move forward another year. So the previous 6 years from today, that will drop off. You can no longer top up that part. So go and have a look at the HMRC website. We will link to this full checklist on the notes of this podcast, which will have a link to take you to the relevant site on the HMRC website that tells you all you need to know about topping up your national insurance contributions. Now, that's pensions. Let's park that. Investments. Now, ISA allowances. Now, we all have an ISA allowance. You can pay £20,000 a year into an ISA. That can be a cash ISA. That can be a stocks and shares ISA. I mean, there are other types of ISAs. We did a whole ISA podcast recently. Go back and find that one. It was about 3 or 4 weeks ago. But you've got lifetime ISAs. There's a lower limit of £4,000 on those. And there's innovative finance ISAs. But overarching, there's a £20,000 limit. Now, if you can, it pays to put as much money into an ISA because it basically protects it from the tax man. Any income tax or capital gains are then hidden in this nice tax-free bubble and your investments can grow. But it's a use it or lose it allowance. There is no carry forward, there's no carry back. If you don't use your allowance, you've lost it. So make sure you use your allowance if you can or you want to, but also use that of your spouses as well. There's another allowance to use if you can, is your capital gains tax allowance. Now everyone has a capital gains tax allowance, and it is around 11,700 at the moment, and that means that if you make a capital gain on something, then usually you have to pay tax. But if it falls within that allowance, then it's tax free. But again, it's a use it or lose it allowance. So what some people will do is they may sell an asset, or they may sell and buy it back to try and utilise their capital gains tax allowance. So it used to be something called, years ago, what people used to do, they used to sell their investments one day and buy them back immediately the next day, because then you realise the gain that you've had, and it resets the initial value of your investments to the price you bought on the subsequent day. They changed the rules to try and stop that, because people were just doing that. It's called bed and breakfasting. But there are things you can still do. You can do bed and ISAing, which is where you may have an investment that's outside of an ISA, and you may crystallise the gain to use your ISA allowance, to use your capital gains tax allowance, but then rebuy that investment within an ISA. And so there are clever things you can do around that. And like I say, if you go to the full checklist, which we're going to link to in the notes of this podcast, there's more information about how you can do that. Next on the list is junior ISAs. So much like a stocks and shares ISA, there is an annual limit. At the moment, it's £4,260 every tax year. So if you want to use that allowance, you lose it if you don't. So you can pay into a junior ISA. Of course, you've got junior cash ISAs, not just junior stocks and shares ISAs. And the other investments you might be thinking about is things like VCTs, venture capital trusts, and these are types of investments that attract really generous tax relief when you pay money in. And the reason they work like that is they want people with money to invest in these VCTs, which will in themselves invest in very sort of fledgling companies. And it was a way for the government to try and encourage people to invest in the economy in a way. They give you a juicy tax incentive, and it will help provide funds for fledgling companies. But obviously wealthy people like it because they get a massive tax incentive in doing so, and it reduces their tax bill. Now, I would never suggest you do an investment just because of the tax incentives. But there are people out there, if they are thinking about doing these things anyway, and they may have a financial advisor who they're going to get in touch with to talk about doing some of these types of investments, then you would need to do it before the 5th of April so you can use your allowance. Moving on to some more tax-related issues. Capital losses. We talked about capital gains. Of course, there are capital losses, and you can offset losses against capital gains made elsewhere to reduce any potential tax bill. But you can also carry forward any losses that you've had or that you've declared within the last 4 years. So again, as we move in from one tax year to the next tax year, that would mean one of them drops off if you don't do it before the 5th of April. Don't forget to use your spouse's tax allowances. That means their income tax allowance. And again, we talked about capital gains tax allowances. And the other thing you might want to consider is being generous and giving money away. And I'm looking at this from an inheritance tax point of view, because there are annual allowances relating to inheritance tax. So as it currently stands, if you have an estate that's worth over £325,000, then anything over that, if you were to pass it on, would be taxed at 40% on inheritance tax. Now, of course, you can actually use your partner's or inherit your partner's inheritance tax allowance. We're not going to go into that detail at the moment. What I'm looking at is the annual allowances, and in fact you can give away £3,000 however you want in any given year, but it can't be carried forward to the next year. So it's like a £3,000 allowance you have, which you can give. There are other allowances as well that relate to specific circumstances. So you can give up to £250 a person, but not in conjunction with that other £3,000 allowance that I mentioned. Then you've got £5,000 you can give to a child if they get married. So you can give them a gift of up to £5,000, and that won't be subject to inheritance tax ever. And of course, you've got your regular gifts that you can do out of income, where you're able to give away as much as you want as long as it's regular, and you are able to maintain your lifestyle. So the point is, if you are thinking about making gifts and maybe mitigating inheritance tax, then it will pay to do so, or it may pay to do so before the 5th of April, because there are some allowances which you will lose as we move into the next tax year. So there we go, Andy. A bit of a whistle-stop tour of a end of tax year checklist.
Good stuff. There's lots of stuff there that I haven't been doing or won't be doing because, I haven't got that sort of money, but it's...
Some of our listeners might do that, Andy.
No, absolutely.
Well, actually, some of our listeners do, as we've met some of them. We've met some of them. But if you want to know more, go and look at the website, because we've done a full warts and all checklist. That was the highlights. So go and have a look at the Money to the Masses website.
Excellent. And I'll link to that in the podcast itself. So if you want to find that quickly, then you just need to go into the notes in the podcast and click the link and you should be there. What do we got next?
Spring. Spring is, well, it's not really spring at the moment, but is it? No, it's not.
It feels spring-like.
No, I think it is.
Is it?
I got excited there because according to the calendar, I think the 1st of March marks spring, but I think we have one of the equinox that means I think the 21st of March actually marks the beginning of spring. And I think we just hit, I think it's today. So anyway, I've digressed away from money and I'm talking about
and you've let people
astrology
in behind the curtain there because it's 21st for us today, but for the dear listener, it's going to be 24th, 25th, 26th.
This stuff is evergreen, Andy.
Of course it is.
It could be the year 2020 by the time they listen to this, and it's still relevant. So spring cleaning your finances. This is just a nice list I saw. I can't remember who did it. I think it was one of the comparison sites, and I've lost it in my memory about things you can look at to try and spring clean your finances. Now, there's some quite obvious things here, but one of them I'll start with is check your credit card interest. Now, lots of us all have credit cards. You bury your head in the sand and we pay over the odds on the interest on a credit card, or we pay the minimum. So if you're going to spring clean your finances, then have a look at how much interest you're paying on your credit card and look at other deals and consider a 0% balance transfer card. Of course, if you do that, you've got to bear in mind there will be probably like a 2% charge when you do move it across. But it's spring. Let's start the spring cleaning. You could shop around on all your bills, so car insurance, home insurance. They reckon if you shop around, you can save on average about £259 on your car insurance. Sounds quite a lot to me, but there you go. One of the ones is look at your credit report. Now, people never do it. It's one of those things you should do once a year and have a look at your credit report. And we're going to link this through to the MOT in a minute. So don't worry if you're sitting there thinking, I've not done any of these things. Where do I go? What do I do? We're going to be talking MOT in a minute. Improving your credit report is one of those things that we all could do, even if we think we've got a good credit report. So that can mean looking at whether you're, well, first of all, you need to look at what your credit report is, get a copy of it. Now, I like Noodle, which is a company that does it. You can go on there and get a free credit report, and they can even, if there's any errors or anything you don't seems a bit odd, you can query it and they will go and actually try and change it for you.
Now, it's interesting you say credit report there because you hate the word score, credit score, because it doesn't exist, does it? There isn't such a thing.
There isn't. This is the thing that, and it's quite interesting, the millennial money piece. This is one of the things we're going to try and educate people on. There's those sorts of ideas. You've got a credit score. You do not have a credit score. Everyone will give you a credit score. So if you go to Experian and all these places, you'll get a score. Or if you go and try and get a loan, you will get a score. But what they do is they look at your report and then they create a score based on their own scoring system. So there's no universal credit score. I mean, there will be similarities between each different lender and the way they score these things, but there is no universal score. So what you need to do is look at your report and make sure it's accurate, but also make sure there are no mistakes on it. But there are other things you can do to improve it by making sure you're on the electoral roll, so you're registered to vote. You want to make sure that you've got bills in your name, so you've got proof of address. That's all part of your credit score. And make sure there's no, like I say, sort of spelling errors or address errors. I looked at mine about 6 months ago, and there was an address on mine that I'd never lived at. And I don't know how that suddenly crept on there, and I sorted out getting that removed.
Do you know, recently I found out that my main pension is actually in the name of Mrs. Andy Leeks. And I had to go through all sorts of jump through hoops to get it all changed over.
Did you have to prove you're a man?
Well, it's weird. I was on the phone to them and I needed to get some information from them. And they said, we do notice, Mr. Leeks, that you're registered here as a Mrs. Leeks. And I can hear that you're definitely not a Mrs. So we'll get that changed for you. So
I tell you what, that was a bit presumptuous. Because I always remember I worked in a company and there was a client. I'm not giving anything sort of confidentiality away here. Somebody who was going through a sex change. And I can't remember their name, but they had they changed obviously to a woman, but they sounded very much like a man. And I knew that they'd become a woman, and obviously referred to them as such. But of course, when they would ring up the company, people would often be very confused because they had somebody who sounded very much like a very deep voice.
Yeah.
So even now, people have to be mindful of the fact that you could have been a Mrs.
Yeah,
you
very
could have
true.
decided, but you probably would have changed your name from Andrew to
Andrea.
Where have we gone with this conversation?
I don't know.
We've gone off piece.
We're back on. We were on improving your credit report. What do we got next?
Boosting your savings, so shop around on your savings. It's a good time to have a look at the saving rates out there. You can do that on Money to the Masses. We do best buy tables. that are automatically updated continuously. So go on there, you can see some of the best rates out there.
When you say about going on to Money to the Masses, just a really quick tip. I've actually pinned Money to the Masses as an actual sort of resource on my phone, and you can do that quite easily by going into your Google app. Stick it on your phone, stick it on your home screen if you can, and just use that as a resource. You can use the search bar within Money to the Masses to pretty much check anything with regards to personal finance. So do that, because I've done it, and anytime I want to find out anything, literally I go to that as my main resource. So do that. Good tip.
We could go on with a couple others. So if you're going to switch bank accounts, go and look at the best switching offers that are out there. We did a podcast again recently. We talked about switching offers. They're always changing, interestingly. They're not as many good ones as they used to be. But go and have a look at the likes of First Direct, Marks and Spencer's. They often have offers. Co-op often do them. So go and have a look around. Money Saving Expert does a good roundup of these things, actually. But overall, do a money MOT. Go on the money MOT. So Damien's money MOT. Go mot.moneytothemasses.com, or if you just Google Damien's money MOT, and it will take you 2 minutes, quick fire questions, and you'll get a full report of a full score of where you are from all areas of your finances, from pensions to bills, wills, savings, you name it. But it's a full spring clean, and then you can register to get an action plan where I'll tell you the best things that you need to do to improve your score and be able to improve your finances. And as I talk, it's only been out a few weeks, and we're not sort of banging on about it all the time, but about 4,000 people have already done it, which is an incredible number for something that we created and hope people would love, and clearly they do.
Brilliant. What have we got lastly? In fact, I should know what we've got lastly because I'm driving this piece. We've got 5 really quick tips on how you can save money on your life insurance premiums.
That is it. Andy is now a deputy editor at Money to the Masses. So Andy's involved in part of the whole content chain that we do and things we write about, and editing things that have been written by others. So this is a piece that's driven by Andy about life insurance, and that is the world where Andy actually came from. Because as much as we talked about Andy's accountancy background, his industry he worked in was life insurance, and Andy used to advise people on life insurance.
Yeah, so there's 5 really quick tips that I'm going to provide you that will hopefully help you to either check that you're paying the right amount for your current life insurance, or inspire you to get out there and get a new quote and see if you can save some money. So tip number 1 is probably the most important, is don't over-insure yourself. And what I mean by that is work out how much cover you'll need. And there's various ways of doing that. You can use online calculators. Damien, how would you work out how much insurance you need?
We've done an article on it actually, but it's based around, I'll give you an example. So for me personally, the first thing I wanted to do was make sure if I died or my wife died, our mortgage was paid off. So we have a mortgage that's decreasing, obviously, because it's a repayment mortgage. So you could over-insure yourself if I took out a level term policy. So for the full amount of the initial loan, and then had that for the term of my mortgage, I'd actually have more life insurance than I needed. Now that isn't necessarily a bad thing, but it does put the premiums up. But if I have a life insurance policy that decreases in line with my mortgage, it makes it a darn sight cheaper, but it actually achieves the aim that I want. That if either my wife or I were to die, then we'd own the house outright, and it means we wouldn't be booted out by the mortgage company when we couldn't afford to pay the mortgage. So that's a good example of not over-insuring. And I mean, sometimes you've got to think about how much you actually need. People just think we need as much insurance as possible. But there is this whole, you've got to have a budget. You've got to be realistic. You wouldn't have ridiculous over-insure your car, for example.
Yeah.
So it's a similar idea. It's got to be within your needs.
I find it frustrating that sometimes people see life insurance like a lottery win, and they're bamboozled by these large numbers. And wouldn't it be lovely to have? Yeah, it kind of would be lovely to have, but you've got to think about the reason you're taking out the insurance. You're taking out the insurance to cover the worst possible eventuality, and that's the minimum you need to cover. So there's other reasons you might need to reduce the cover.
But one of the things saying that, Andy, don't forget, you must remember that if you're taking out life insurance and it's got a term attached, it's incredibly likely it will never pay out. So you're paying for something that is probably never going to pay out, because if you take out, like I did, a mortgage when I bought a house 10, 12 years ago, and you had a term on it, then the chances are statistically that I'm going to make it beyond the term of my mortgage, because, well, that's just the averages of life expectancy. And don't forget, no one would lend me a mortgage for that term if they didn't think I was going to live. So there's an element of that life insurance policies, like Andy said, it's not lottery. So you've got to be within your budget. If you can afford lots, great. But don't forget that insurance companies don't like you over-insuring yourself anyway. So if you actually took out insurance or started to apply for lots of insurance, they do talk. It's called, they reinsure the actual initial policy. They all pass on that risk. So they will start looking at, well, how come Andy's insuring himself for 2 million here? And they could stop it. They would actually say no, they would refuse it on that basis. Sorry, Andy, I've jumped in.
That's all right. There's That's fine. There's other reasons why you might have overinsured yourself. You may, for example, have originally taken it out and you had lots of debt at the time. You may have paid some of that off or all of it off, in which case you may need less cover. You may have also built up some savings, which could act as part of the buffer that you need, and therefore you need less insurance. So just check how much you're insured for and whether you really need that level. Another quick tip is to buy the right type of policy. Now, there are lots of types of insurance out there. Just make sure that it's the right policy for you. Damien already mentioned that there's two types of policy really that you could use to cover your mortgage. You can have a level or what they call a mortgage protection policy, which is a decreasing one that decreases in line with your mortgage. It's cheaper for the latter, but there's other types of insurance out there as well. There's something called family income benefit. Sounds like something the government might throw out at you as a benefit, but it's not. It's another style of decreasing your life insurance payouts over time. So every year that's paid out is a year less that they'll pay you. And so the cover reduces over time. And that's actually a cost-effective way of getting life insurance that decreases over time.
Actually, on another note, I am jumping back in again. But I always remember when we used to have really wealthy clients. And so you always think that life insurance is used purely, or critical illness cover this was particularly for. So critical illness is if you're diagnosed with a critical illness, there's certain types of cancer, it would pay out. It doesn't mean you've got to die, it just means you've got to be diagnosed with it. And of course these days, a lot of people will survive critical illnesses. So it just means you get a payout, a big payout, that could clear your mortgage or make life a bit easier. And well, when we used to do financial plans for people, we used to think a bit creatively about that, because the people would sit there and think, well, do you know what? I want to fund my pension every year until a certain time, and then that's going to be my financial plan. I'm going to be financially secure. So we had people who took out a decreasing policy, critical illness policy, would equate to the amount they were going to pay into their pension or their savings or whatever it was every year, so they could actually have that pot of gold. And so it was kind of a novel way of using insurance to be able to make sure they could still save in a way, because if they suddenly got really unwell partway through the term, then it would pay out enough money to make sure they did get that financial independence. So it was a quirky way of doing it. It wasn't really, I suppose, the way they think it was designed, but if the insurance company understands why you want it and what the reason is, they will accept it. Anyway, I've jumped in again. Sorry, Andy. Back.
No, that's interesting. So that's it. That's tip number 2. And if you don't know what type of life insurance policy you've got or what you need, then go on to Money to the Masses, and there's lots of information on there. Tip number 3 is basically get yourself healthy. When you took out the policy, you may not have been as healthy as you are now, or you may be intending on getting yourself healthier going forward. And what I mean by healthy, basically, the insurance companies will look at you as a proposition and how expensive it is to cover you. So those questions that they ask you about your height and your weight, whether you smoke, whether you drink, what sort of sports and activities you do, that's not because they're being nosy. That's because they're looking at you as an insurable interest and how expensive the premium is going to end up. Essentially, how likely it is you're going to die. If you're more likely that you're going to die, your premiums are going to be higher. That's simple maths. That's how it works out.
But on that, I've got Crohn's. Everyone knows I've got Crohn's. I talk about my Crohn's. When I took out life insurance a number of years ago, I actually got rejected because I'd been really unwell, and they didn't want to insure me until after I had a period of time where I wasn't basically going to be really ill. But then I took out a policy and it was really expensive after about sort of 6 months, a year. But then my Crohn's then calmed down for a period of time. And so when it isn't just about always being healthy, it's being healthier. And so I was technically healthier than I was when I took out the policy. And if I could get a cheaper policy by just going out and getting another quote and getting it rebroked, or taking out a new plan and cancelling the old one. I mean, I had to make sure I could got the new one in place before cancelling the old one. But yeah, it's about being generally healthier. Maybe you don't smoke anymore, that sort of thing. If your health has improved, you could save money.
Yeah, if you're making better lifestyle choices now and you think that you'll be a better proposition to the insurance company, then you need to be thinking about getting some newer quotes. I've lost 5 stone in my lifetime, and I know for sure that my premiums after I'd lost the weight than before I'd lost the weight were a hell of a lot cheaper. And so if you've given up smoking, which I've also done, I'm assuming we all smoked when we were young, Damien. Poor choices.
Poor lifestyle choices. 5 stone.
Yeah.
Amazing.
I know.
Careless. but amazing. One thing I want you to explain, Andy. We were in the office today and we had a discussion around the benefits of having 2 policies versus 1. And what I mean by that, so my wife and I, whether you have a joint policy, so us covered on 1 policy and it pays out when one of you dies, and versus the benefits of having 2 individual policies where each would pay out. Well, my one would say, for example, pay out when I died, and my wife's would pay out if she died. So technically you had 2 policies with 2 potential payouts versus having a joint one with only 1 payout.
Yeah, so this kind of almost takes us back to the tip number 1 is don't over-insure yourself. So some would assume that by having 2 policies, it would be double the cost, and so that would be over-insuring yourself and you don't really necessarily need it. A good tip for you is to find out how much it costs for 2 single policies, because in a lot of cases, having worked in the industry for 15, 16 years, the cost for 2 separate policies, i.e. doubling up your cover, doesn't double your premiums, or in fact anywhere near double your premiums. You're probably more likely to pay somewhere like 10 to 20% more for double the cover. So just work out whether it's something you want. And you might be asking, well, why would I need double the cover? Well, that's a really good question. But there are situations where one parent, God forbid, they were to die, that remaining parent on a joint policy would actually lose their cover. Now, if that's paid off the mortgage or paid enough money so that the surviving parent can give up work and do what they need to, then great. But often what will happen is it will serve a purpose, like it will pay off the mortgage or provide a lump sum, but then the remaining parent hasn't got any sort of life cover at all. And so they then have to go and get underwritten and take out a new cover, and it's a bit of a faff. If you have 2 from outset, then you're all good. And actually, if something happens to both of you, like a car accident or something, I don't like to talk about that kind of thing, it does provide a double payout, which for the children who are left behind is quite good.
Yeah, so the point is if you ever have life insurance quotes, we're going to look into it, ask about the 2 policies, because you can also get the case where you could theoretically, and I've seen it happen, where 2 single policies, so therefore you're getting double the cover, is actually cheaper than getting a joint one because they've got them. You don't have to have the same insurance company. I could have my cover with an insurance company that's very lenient on Crohn's and therefore gives me a reduced rate, a rate that is lower than somebody else would, and my wife could have another company altogether. So together, it can actually work out cheaper in some way. So it's a tip. Just go and ask about it.
Yeah, and often if it is the same insurance company, then if you take out 2 policies, you can put it in what they call a menu plan. It's like a package type policy, and you get discounts on each policy because they're linked. So it's a bit like packaging them together because it's less admin for the insurance company. And so they'll knock off £2 on each policy and you save that way. Tip number 4 is buy now. Life insurance, and when I say buy now, obviously only buy it if you need the cover. But life insurance is really quite simple. It becomes more expensive the older you get. The older you get, the more chance you are of dying, and so the more expensive the premiums are. So if you know you need cover, don't think, I'll do that next year or the year after or when I've got more money, because you're kind of putting off the inevitable and you're going to end up paying more. So if you need cover, get online, get your quotes, get yourself insured now, because you'll save money in the long term.
Yeah, and number 5, I'm stealing Andy's glory here, shop around.
Yeah, just shop around. Go on to moneytothemasses.com, check out our articles, and we've provided some links for some people who we think are really good at what they do and can provide you with the best cover and give you advice as well. And crucially, if you actually end up speaking to an expert, an independent expert, what they will do is they'll tell you if you've already got the right cover, and they'll tell you not to buy anything.
Yeah, because you may have cover through your employer, and that's the other thing. You've got to think, what does your employer, but one thing to bear in mind, if you change jobs, you lose that cover. So people go, I've got it through my employer. You have to remember, if you change jobs, you've got to think about what happened to the death in service benefits and life insurance cover, whatever it is you had with your past employer. You need to renegotiate that with your new employer, or factor in that you've got to now pay for it.
That's a bit awkward because I've just changed employers. Right, if you want to get in touch with Damien, you can do. It is Damien at moneytothemasses.com. Get on Instagram. There's lots happening over there, and the lovely Lauren is doing wonderful stuff. So search for Money to the Masses on Instagram. Twitter, Damien loves a Twitter rant. Actually, you haven't had a Twitter rant for a little while.
No, I did make some mention of Lorraine Kelly today.
Okay.
Which, we won't say. It's about her tax situation. Go and have a look on Twitter. You'll have heard the story probably, but go and look on Twitter. Unbelievable stuff. Anyway.
That's at Money to the Masses with the number 2. And that just about wraps it up. So do make sure you get onto the MOT. That's mot.moneytothemasses.com. And finally, just share the love. Please review us. We've had a couple of reviews lately. We'll probably fit them in next week. We've gone a bit over this week, and we'll read you out. So if you get yourself onto iTunes and review us, we'll read out your review on next week's pod.
Until next week.
Until next time.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.